Hi, Harry here in mid-July with the Rant. And of course, this is timely because I've been saying for months that this is where I'm expecting roughly for the first wave of this larger crash to bottom. And so far, it looks like it bottomed on June 16th for stocks, down about 35% on the NASDAQ. Now, that is clearly enough to qualify it as a first wave that denotes a long-term crash and not just a correction. It's not ideal because it would have been better if it had been down more like 40% and in 3 months or 4 months instead of 5.5 into June. But still, this clearly looks like we've seen a top. Of course, I've been expecting this all the time since January 4 on the S&P 500, the last of the major indices to top. So this is a time for people who've been short stocks to consider, oh, maybe I want to take some profits here, or maybe all together. Now remember, the only way to fully catch a crash is to be there the whole time, because the market has a way of going down just when you get out, or if you're short, or going up if you're long, just when you get out thinking, to protect your profits or something. But this is the best time to lighten up. And I am expecting, as I've been saying, a bounce, probably, since it's been down 5.5 months, 6.5 months, if we do happen to retest the bottom fully, it looks like we're just going sideways here and about to head up again here in mid-July instead of a new low. So expect about 2 months, I'd say into mid to late, probably late September be my best guess with the cycles and stuff. We get a bounce and then we go into the next major wave down. Remember, every major crash should be a 5-wave sequence. 1 wave crash down, 2-wave bounce, which we're about to go into, 3-wave crash down, usually the worst, if any, of the 3 down waves, 4-wave rebound again, and then a 5th wave finale. So I would say that, later this year we bounce into September or so. That 3rd wave will be coming between maybe late September or so and early next year, February or March, another 5-6 month decline at least. So that will be the easiest to catch. That's the point. Because the first wave is always, hey, is it really a top for a long time? Well, now we know it's a top. And now the rest of the sequence, the 5-wave sequence, becomes more predictable. So again, this is a good time to reevaluate your portfolios and really say, hey, where do I want to be? And you might not want to be short stocks in case this is a strong bounce. So that's for the people that want to make profits on the downturn. You're almost going to have to play stocks. And bonds are the defensive play. Bonds are a way to not just be in cash and protect what you have, but to actually make money, because the Treasury bonds do become the safe haven in a crash like this, especially one that's heading towards deflation instead of inflation, where gold does better. So gold is not the safe haven. I keep saying that. Gold is peaked back in March. I don't think you're going to see higher than that, and it's going to keep going down. It's a better place to be than stocks and most risk assets, and certainly other commodities, but gold is not the safe haven. So the Treasury bonds are. The Treasury bonds do look like I showed in the newsletter. It looked like at 108 we saw a major bottom, a major megaphone pattern with one more strong wave up. Bottom at 108 in TLT, the 20-year Treasury bond ETF, with a target of 196. Now we're up at 116 here, so about up 7-8%. But it's still 196. So I'd say TLT, if you're not in, you want to get in, I'm hoping it pulls back to 112, 113 area, okay? It may or may not, because I think it knows it's made a bottom. But if you see it there, that's probably the last chance to get into the Treasury bonds. And what you have to understand with the Treasury bonds, you have to be patient. It is the safe haven place. It will go up modestly, as it did in the early stages of the 2008 crash for several months. Okay, it just trended up. Okay, but it spiked at the worst of the crisis in November, December, late 2008. Okay, so that's what we're looking for. So don't look for Treasury bonds and just kill it here, the TLT. But boy, when the crisis hits and stocks are really down, heading closer to their lows, that's when it's going to show, and that's when it's pay off. So So if you want to make more money, be short stocks. If you want to be short stocks, hey, wait for a bounce here. It's too late to get into short stocks now. And again, hopefully about a 2-month bounce. I'll keep you updated on that. And then a short in stocks will play off more aggressively at first. And in the end, the bonds will do the best. So it's up to you and your risk tolerance to decide if you want to just be safe haven, sitting in the TLT and the 10 and 30-year Treasury bonds, the safe haven, and you're going to protect yourself in a downturn and do very well at the best, or do you want to be more aggressive and be shorting stocks? So again, you consider that, and I'll keep you updated on both.